Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates, and 10-year note yields continue the trend higher. In fact, highest we've seen, really, we exceeded those levels seen in 2013. Remember, that was the taper tantrum. We got to go all the way back to 2011, mid-year 2011. Last time we had yields this high, nearing 310 in the 10-year note. And that trend that we've seen just continues to build on itself. And the market right now has seemingly, as far as yield speak goes, we have probably not seen the top yet. We know if we get back below 3%, this trend run will probably be over. But that right now is between, somewhere and nowhere. And I don't think that the market is going to see a massive pullback without any unforeseen events that come across the table, which right now doesn't look like they will. And if you look at volatility, volatility is starting to move. We've seen a big bid in the last day and a half or so, based on the fact that, one, we're now trading in what we'll consider uncharted territory as yields continue to go higher, breaking outside of the range, outside of expectations. How high can they go? And for the most part, with all the other geopolitical risks on the rise around the world, it seems that it's all coming together. So right now, as the 10-year note continues to trade outside the old range, the comfort zone, we continue to see volatility bid. And if we do come back towards 3%, expect volatility to really get crushed. So right now, volatility part of the equation, something it hasn't been in a long time. Yields in uncharted territory. What do we have ahead? What's going to keep us where we're going on this path, or what's going to bring us back? Well, we do have trade talks with China. I think ultimately trade is going to be a big part of where 10-year note yields go as far as risk pricing goes. Likewise, we have the summit with North Korea coming up, not for about another month, but certainly will remain on everybody's radar. And the strong data we've been seeing has been feeding into the Treasury rally in yields. And so right now you've got a lot of things happening, whether it's uncertainty and strong data, the Fed may be having to act a little more aggressively, and likewise you've got a dollar that's been bid through the roof. So there's a lot of reasons why Treasury yields can continue. We will likely see some resistance in that close to 320. I think a lot of these leverage funds that are short the market may look for that as a first stop. Maybe they'll be buying back some of those shorts. It's uncertain at this point, but I think that would be certainly a level where we may see a little bit of a pullback. You may want to take some chips off the table, but at this point it looks like we are going to continue this trend, at least for the short term, until we either hit a snag with some data, unless we get some kind of peace in the Middle East, or we get some kind of resolution with China, and then certainly once we get through the two big events in June, which is the summit with North Korea and the June FOMC meeting. So a lot of things still ahead, but Treasury yields continue to push forward and higher. This is Todd Colvin coming to you from the floor of the CME Group.